Welcome to Subramani. It took me a couple of days to realize that I got some combination wrong and therefore the volume was low. Hopefully from today the volume would be much better. One question which I want to answer, which I've answered very many times, is which I'm being asked regularly. I think people should just go back and see some of my older videos. Is what to do now that the market is so weak, right? Or market is so low, or I don't know what they mean in the current market conditions. To me, market is not in a very bad shape, nor is it in a very great shape. Is it a time to be investing? Well, the answer is very difficult, but if you're going to sell in 2030 or 2040 or 2050, of course you should be investing. If you want the money by Diwali, maybe it's a wrong time to be investing. So it's a question of not what the market is doing, the question is what you are doing. So to answer the question, what should I do now that the market is here? Believe me, my answer remains absolutely the same. It does not matter whether the Sensex is 40,000, 50,000, 60,000, 75,000 or 100,000, right? It does not really matter to me. My answer remains the same because my answer is divided into three parts. One, check your asset allocation. What is the asset allocation with which you are happy? It does not matter what anybody else thinks, right? So check your asset allocation. If you are happy 60% equity and 40% debt, given your asset, given your age, your profile, your the cash flow that you have, the cash flow that you need, whether your children are earning, whether you're 24-year-old, I'm not getting into all that. Are you happy with the asset allocation that you are doing? The asset allocation should allow you to sleep well. It should allow you to eat well, right? So these are the two things that your asset allocation should do. If your asset allocation keeps you awake at 3 a.m. not knowing what to do and sitting up wondering what to do, then maybe your asset allocation is wrong. But if your asset allocation allows you to sleep well and you have 70% in debt and 30% in equity and you are happy with that allocation, then be my guest, you can be that way. I am 90% plus in equity and I have always been like that. Whether the market goes up, whether the market goes down, to me doesn't really matter. So do I have some cash? Yes, I have cash and I know that my cash is likely to hold on, will sustain me for 10 years. So that much of cash also I have in some debt funds, PPF, etc. I also know that my dividend income is 3x or 3.5x my annual expenses, so that's also taken care of. Even if my dividend income were to fall, that takes care of my household expenses. Plus I continue to have some current income doing some work here and there. So that is how I take care of myself. That is all the other insurance that I have, so I can afford to be 90%, 95% in equity, and that number keeps increasing because the debt allocation does not increase and I don't have too much of real estate for it to appreciate. So my real estate is very close to zero. It's just one house which is given on rent. The self-occupied house and the self-used office is not to be considered as far as net worth is concerned. So that brings us to what is the asset allocation with which you are happy. So first that. Second, if you have continuous cash flows, keep investing. Do an SIP. Don't worry, I'll get to the next one later. So if you are happy with the money that you have, keep investing. Don't worry about the market being high or low. Market keeps doing whatever it wants to do. Whether the market was high in July 2023 or 2022 or 2024, you will know only 6 months, 8 months after the event, not now. So after if the market is 20% higher in July 2023, then you will say, oh my God, July 2022 was so attractive. If the market was 20% lower, you would say, oh my God, I wish I had sold in July 22. So it doesn't really matter. Don't go by what your mind says. Your mind says whatever is convenient. Your mind does not say what is correct. If you want to see what is correct, then you have to write down your feelings for the day and then flip your diary after a year or two and you will realize how wrong you were. It has happened to all of us. So I think the most important thing is to maintain a notebook in which you write down your feelings and you will know how wrong you were only in retrospect, not now. Having said that, so find out your asset allocation, what you're happy with, continue investing. And another very important thing, don't be on social media. Don't try to use social media as a guide. You have completely nonsensical comments coming there saying, if you had done this, this would have happened. If you had invested in small cap, you would have got 15% return. If you have invested in large cap, you would have got only 13% return. So therefore, moral of the story is you invest in small cap. Don't get into all that. If you are worried about market capitalization of your investment, get into a flexi cap and make sure that flexi cap is adequately representing mid cap, large cap and small cap, right? So make sure that you are happy with that. Whatever makes you happy is important. I used to do a lecture called Santushti hi Sampatti hai. The satisfaction has to come from within. It does not have to come from outside. So I tweeted recently saying that if you don't know how much is your net worth, if you do not know what is your asset allocation, you just broadly look at your finances once in a year while filing your income tax returns, it means you have reached that stage when it does not really matter as to what is happening in your financial life. Yes, of course, money is important, but you have reached the stage when, maybe you need 2 crores for retirement and you have 20 crores. You know that whatever you do, you're punching way below your weight. So if you're doing this, then it does not matter what is your asset allocation, right? So remember also one thing, that market can be at all-time high and can go higher. The central bankers who were considered heroes a few months ago are considered villains. Their main aim is to reduce inflation, so they will keep increasing interest rates, and as they keep increasing interest rates, your asset prices will fall. So please understand, it is not that when interest rates go up, equity prices fall. When interest rates go up, asset prices fall. So your real estate or your equities or anything, even bond prices, everything has to fall because interest rates are going up. It is as simple as that, right? So because of that, it looks very difficult not knowing where to invest. So this is my logic is, if you don't know where to invest, choose a multi-asset fund, because you will still have 20-30% in equity. So some equity presentation will be there. Gold has not done well recently, and gold funds, investing in companies which manufacture gold or mine gold, they have done even worse. So maybe it's a good time to be buying gold. If you don't know what to do, be in a multi-asset fund. That makes sense the maximum. So the question is, where should you put your money? If you don't know where to put your money, and you have to put it in the multi-asset fund. You can also put it into some balance advantage fund. Please understand, there are different types of balance advantage funds. So whatever suits you. If you ask me, I am totally in equity, but that is because I've been in equity for a very long time, 1979 to be precise. So that is 21 plus 22, 43 years I've been in equity. So I know I shouldn't panic. I know I have other insurance, so I will have other cash flows to take care of me. I don't have to bother about it. I know when the market goes down, market will go up. I also know that markets don't go up or down. It is just sector allocation or a sector reallocation which happens. I have lived through it. I know how I will react when the market goes down. If you do not know, learn. There is no escaping that. If the market goes down, will you panic? That is something which you should worry about. If the market is down by 20%, I will sigh and say, oh, we are now into Investopedia's bear market, right? That is again Investopedia's definition of a bear market. That 19.1 is still okay, but 20.1 means you're in a bear market. I don't understand numbers as well as I wish I should. So whatever, you have perfectly right to get scared, right? So when I look at some of the shares which I have bought and I look at the prices, it is scary. It is saying, oh my God, what have I done? But I don't have to panic, right? So panic is optional. Fear is obvious. It is bound to be there. If you don't have fear, it means you're not passionate about what you're doing. So fear will be there, but that does not mean I have to panic. It does not mean when the price goes down, I have to sell. For example, I bought CARE at 540 or 550. I thought it was a good buy. Then the prices fell. It fell down to 405, 410. I don't think it broke 400, but at least 410, 420. I bought more because I was convinced that it is a good share and it is a good price. Now suddenly the price went up 20% last week because they announced a buyback. I did not react to that. In fact, I reacted to that by selling some of the shares which I bought at 400 because I believed that was a good trading opportunity. So I got rid of it at 490 or 488 or something like that, right? So I got a chance to buy it back, so I bought it back. So I keep doing that because I know I will remain calm when the market falls or when the share which I have bought falls. You find out how you will behave when the market falls. The market will keep falling and raising. It will go down in maybe 2022, maybe it doesn't come up in 2023, maybe it comes up in 2024, but you would have accumulated units if you were doing an SIP. So you do what you should do, the market will do what it does. Don't react to the market in a very childish and immature way. That will hurt you. Thank you.